You know,
Get some pretty awesome stories.
exactly. Exactly. Remember that time? Yeah, remember. I mean, I don't know. Like, dude, this is a small enough place. Like, we should all be able to, like, I don't know, right? Pick you up when you need to get picked up, and exactly. There's enough people. All you gotta do is get the couple A, take the something to get the couple A, and then you get picked up from there, right? Who does? Oh yeah, the 40. Yeah. Oh geez, yeah. Yeah, you could do that. God, every week I gotta do this. Okay. Okay. So, today is the last day I'm talking about the repo market. I don't want to talk about it anymore after this because it's just getting more and more depressing. And also, it's not the focus of this class. So at some level, I just say, fine, I've now taught you enough, and I move on. I think I said that last week, but I just want to do a little bit more. The lectures are getting recorded, so we're good on that. I'm getting better at how to record them. So I'm getting there. 1:30, I think, is just going to be a problem. It's hard. I need to get better at this. And I thought at first that I'd be able to do it well. And I realize now that I can't. Okay. So what I did to make my life easier today is, unlike I usually do, I made kind of like a PowerPoint, with the benefit that you are getting, with the benefit that it's a little bit faster for me to make the notes, which I was kind of like pressed for time as enough as it was. But I still didn't want to just be like, oh, fuck it, just check out this website. It'll tell you what you need to know, kind of thing. I mean, because again, and not that I need to justify it to you, but my process of making the lecture is tomorrow will be the day I start thinking about next week's lecture. I think about it in the back of my mind on my half-hour drive here and back. This one, I don't think about the 1:30 or 1:31. I mean, that's but I think about this one every day as I'm going back and forth, and it kind of culminates usually on Tuesday, where I then start to formally write it out. And I write it out on the legal pad, except for today. Today's lecture, just because I'm running out of time to do my other shit to keep my job. So what that means is that yesterday I started making 2 PowerPoints, and in making these 2 PowerPoints, I want to talk a little bit about the repo market. Then I want to talk most of my time about the economic outlook project that you will need to have completed 3 Thursdays from now. So that is going to be the deadline, is 3 Thursdays from now, which is like the October the 17th. Okay. So that'll be our due date for that. With the number of people we have in this class, we should be able to do 5 to 10 minute presentations. But when it comes to actually what I'm expecting of you, I'm going to expect a slide presentation of some type, short write-up. I'll give you a rubric beforehand so you know what you need to do. So it should be pretty straightforward. But let me... What was that called? Economic what project? Economic Outlook project. And corresponding to that, I want to do the, after that's done, I want to do the, in thinking about the midterm, create something rather short. I don't think it needs to be rather long because my focus is more on the Outlook project than on the midterm exam. I do have to give you something just for my own assessment purposes, but I want you spending your time on other things. Okay. Did you win big money? Did you win big money or no? No. Okay. Okay. Well. Oh yeah, I gotta remember I have to do this. How do I do this? Why do I ever show videos? Why do I show videos? Why do I show videos? I should remember not to show videos. You would think I would remember. Seriously, what did you do in Vegas? Did you go to any unlimited eat as much as you can places?
No,
What'd you do?
we didn't really
You went to what?
we didn't really do.
So did you like, so what did you, yeah, so tell me more. I haven't been to Vegas since,
There's a lot of construction.
Hmm.
Um,
Was it worth your time?
no,
Yeah, that's how I usually feel on a work trip. That's how I usually feel, which is for me, then I just feel shitty when I come home because everyone had to work really hard for me being gone. And then I realize, fuck, like you did it for nothing because it wasn't that important. Oh well, what are you gonna do? Did you feel that way though after being gone then, that you felt shitty for being gone?
no.
No. Then I wouldn't worry then.
I think because I was thinking it was a short trip.
How many days was it? Well, look at that person's tooth.
I
Oh,
could sleep 3 days out of the office.
yeah, it's not bad.
Yeah.
No. Okay, where's the volume?
Recent action in the repo market, the overnight market says that moves in the funding market were quote outside of recent experience. Kind of another way of the Fed president saying that they were a little surprised by what happens. They weren't prepared to supply liquidity, and we happen to know from our own reporting that they were indeed in a state of heightened monitoring of the markets on that Friday. The trouble, they said, was that markets were not distributing liquidity effectively. Translation, there was enough stuff around, it just wasn't getting to where it needed to go in the right way. So the Fed came.
Okay, I'm gonna pause it right here. Because I'll carry this around with me so that's recording too. What I'm saying. So what's important about so this guy, Steve Leisman, is basically the chief economics reporter for CNBC. So any major economics conference, he's actually usually there reporting on things. So he said two things there that were of note so far. First thing being that the Federal Reserve was continuing to get involved in the repo market. As of today, they've made 11 interventions. So this is the 11th intervention since 2008. So all in the past week. The other thing that he just said, which is kind of the point of what I'm going to talk about here in the PowerPoints I made here, is that the Federal Reserve is supplying the money, but it's not getting around. So in the kind of independent reading I was doing this past week, I'm still concerned with this issue that we talked about 2 weeks prior, which was this issue of what is happening in the market. Is it the banks don't trust others, or is it that people are asking for all the money? Like, what is it that's causing this 10% interest rate in the repo market? So in this case, why is the market not distributing liquidity effectively? One of the I don't want this to be a murder mystery because it turns out that there was some research done last year, which I only read this week in preparation for this lecture, which was that that in terms of the banks that supply the money, the top 3 banks in reserves are 60% of the market. Meaning that when we talk about these banks like too big to fail, we usually think of it as, we usually think of it in these terms, that the 7 biggest banks in the United States hold 86% of the total deposits, right? And you're like, so what does that mean? It just means you've got fewer bank branches to go to. But the consequence is much deeper than that, because what it means is that when we talk about who can others borrow money from at an overnight rate, there are fewer big players out there. And the smaller players are the ones that don't have access to the market like the big players, which means the Fed's putting all this money out there, but it's the big banks that like just are refusing to lend the money out for whatever reason. And since they are the biggest players, it doesn't matter what all the small players do, right? This is the equivalent of like, think of a very saturated market like the automobile market. This would be like Fiat, GM, and Ford all saying, we're not going to do this, and Tesla being like, we're going to do it, right? But in terms of the scale of the market, Tesla's an incredibly small player. Okay, let's go back to Mr. Leisman.
Hey man, and they say that he says the reason would be the market strength. If we're not out of the woods yet, William says there are potential strains in the funding market coming at the end of the quarter. That's why the Fed this week will do 3 2-week operations that will tide over the market over the quarter end. And the Fed will continue to monitor and analyze the market closely and assess whether, among other things, to resume growth in reserves. Carl, from our own reporting, New York Fed officials also saying one of the areas they're looking at is why didn't the bank step up? They knew there was a potential cash squeeze on that Monday. They expected, they saw that the levels of reserves in the system, the level of liquidity was ample in the bank, but the banks didn't step in as they expected. So that's one of the.
So see right there, like why are the banks not lending out the money? So in some sense, Williams is saying, dude, I didn't think I was going to need to intervene because the banks, right, the Federal Reserve would know what the reserve levels are. And they said, we thought they would use those reserves to lend them out, and the banks did not lend out the reserves.
Things they're analyzing to understand why they have this crunch where a rate that should trade around 2%, for a while they're traded above 7%. Carl?
Steve, rates are fairly well behaved this morning.
Yes.
Are we back? Is it fair to say we are back to normal for now?
You know, I wouldn't give it all clear just yet. They offered up to 75 today. The banking system took down just 65. That is a good sign. We put a couple of these together. The question becomes, why is there so far a continued need for liquidity? Why the Fed has to keep injecting this money? By the way, the money's not.
That's a key point. Because remember what we said, one of the possible theories why there was so much money needed a week ago, right, was that all these 3 things came all about at the same time, like they do every September. The fact that the market is still having problems indicates that it's something more than a technical issue than just that September.
Cumulative, Carl. It's not 65, 65, 55, or 75. It rolls over on the night, and so it ends up being just a net of 75. But we don't quite understand why this money is continuously needed. A lot of talk and it's insurance that this is not a credit crunch like the financial crisis time. This is something different, more technical.
All right, Steve. Well, we're not done talking about it.
Carl's got a nice haircut, huh?
Steve, thank you.
Carl Quintanilla. Probably, but isn't he like
I would say if you think about how domestic political and really more broadly geopolitical risks have
Are you saying it's not like the financial crisis?
well, that's what he's saying. I mean, so right, I mean, so the issue does become one of like, yeah, what's the reason for it? And we still don't really know. I mean, that's kind of the problem here. Well, it could be, but I mean, well, so it could be things as simple as some concern about maybe a concern about being ready to for a stress test. It could be something like that, but that's not likely. I don't want to do this for each video here. So this here. And I'll make this available. I'm not going to go to this because it's so, well, let's try. The app on your phone that you can download for Fred is actually pretty cool, because I'd actually never looked at this chart before last week. Why would I? Because it's a whole lot of uninterestingness. Look at that, right? I mean, that's a whole lot of uninterestingness. But what's cool is as I scroll down here, it's going to be really cool here. Okay, so if you look at, I mean, this is why I've never looked at this chart, because again, nothing's really been done in this repo market in terms of Federal Reserve intervention since the credit crisis. And there's where it gets a little bit more interesting. So again, interventions are actually pretty commonplace leading up to the crisis and during the crisis itself. But the reason why was because we really do have this transition from a banking system that relied heavily on fractional reserves to one that does not lend out all the money, which is why you really don't see a lot going on after the credit crisis, which then you can kind of see that the peaks are really that peak right there in 2001, that's September 11th attacks, right, where there was massive intervention needed. Otherwise, I would suspect that most of those little peaks you see going forward are the September peaks. And then it ends. It ends because that middle point of the credit crisis represents the banking system making that wholesale shift from fractional reserve to not full reserves, but lending out only a portion of what they're legally able to lend out. Okay, so let's go back to slides. Okay, so let's look at these repo market interventions here. Okay, so let's look at what's been done since last week. So if we look at what's been done last week, as Steve Leisman was talking about at the end of that video, that basically the money is cycling in and then cycling out. And what you're seeing here is the supply of money and the demand for money. And you can see, especially in the beginning, there was this wider disparity between supply and demand conditions. It's basically becoming more stable at this point. But again, the issue is, why has a market that traditionally didn't need any of this money all of a sudden need this money? And why is it so consistently needing this money? Right? I mean, so the money that, so I said this is the 10th or 11th intervention. I mean, it's just a continuing kind of thing, right? It's like getting it's like writing a check and getting a line of credit at the bank, right? Like essentially, you could pay that all off today, write another check tomorrow that then draws on that line of credit again tomorrow, right? These are short-term loans. But what this means here, what this picture means for us here, is that the market is still not resolving itself since this problem really started on the 17th. This repo market still has a problem. And here's what I thought I would do, because we kind of talked about this a little bit. These are who the primary dealers are. We kind of had this question before about who are the primary dealers. These are the primary dealers. You would notice here you've got your big players, Bank of Nova Scotia, Bank of Montreal, the French bank BNP Paribas, Barclays, B of A, Cantor Fitzgerald, which deals only with government securities, Citigroup, Credit Suisse, Deutsche Bank, Goldman Sachs, HSBC, Jefferies, JP Morgan, NatWest, Nomura. You have a set of large American, Japanese, European banks, essentially. And Canadian banks, I suppose. Now, what do they do? So, again, I made this based on this idea that explaining a little bit more who the actors are that's kind of causing this problem. So the primary dealers are the middleman. They're the ones that get the things from the central bank. They get the reserves from the central bank, and then they coordinate and distribute those monies from the Federal Reserve Bank to all the other banks, all the other financial institutions. But look at point number 3. So this is when I wrote this, I was thinking exactly through Steve Leisman's issue of like, why are the banks not lending out the money? Right. So bullet point number 3, when the Fed lends the money through the repo market, then people are expecting that the money is going to be recirculated out by the primary dealers to all the banks that need it. But what if they don't? What if the primary dealers get the money from the central banks, and those are big banks? What if they get it from those big banks and they do not lend it out? Which is exactly the problem that the credit crisis represented, right? Was that the credit crisis represented banks taking in reserves, if anyone ever saw that, remember the movie, it was the one about the credit crisis, but it was the one that HBO did. I don't remember the name of it. But the problem, the way that the movie ended, was the 7 biggest banks all being brought into a room, the FDIC and the Federal Reserve saying, you need to take this money, we're going to partially nationalize you, and we're going to own shares of your bank, with the expectation being that the banks are going to lend out the money. And they never did. Right, basically what we knew as TARP, right? The Troubled Asset Relief Program. Banks didn't lend it out. And so we're seeing nothing different going on here, which is why I don't understand. Well, I do understand, but basically we're being told bullshit, right? I mean, it is a lot like the credit crisis in the sense that, right, what's that like phrase where you can't like drag something to water, a horse to water or something, right? I mean, that's essentially what's going on here, is that the Federal Reserve is supplying the money. That's not the issue. It's that the primary dealers are not lending it all out to everyone else. And that's my 1, 2, 3, 4, 5, 5th bullet point. Is that what if the big banks hold on to all the cash, they don't lend out enough, and then the small players get really squeezed. I don't want to go back to, well, let's go back to the chart. Why not? All of these banks are not equal. Some of these are like shithole places that you'd start your career off in, right? And you'd get your experience, but you wouldn't want to be there forever. I hate to pick on anyone because they all do great stuff on some level, but dude, I mean, if you told me you're at Bank of Nova Scotia, that's good for you. You know, that's a great job to start off at. You don't want to end your career though. You'd only work there as an experienced person if you get kicked out of someone else. NatWest, that's a big British bank, like 20 years ago. They're not as big anymore. They're not Goldman Sachs. Goldman Sachs is really the biggest primary dealer here. Cantor Fitzgerald, big primary dealer here. what happened in 2001, remember that big peak we saw in 2001 for September 11th? That was because Cantor Fitzgerald, the company was based on the top floor of the one of the World Trade Center towers. So they lost like 75% of their employees. So like, right, that you almost lost a primary dealer there. So you needed this huge flood of cash, right? Because Cantor Fitzgerald was no longer in it anymore. But let's go back to this. So this problem that we're seeing, and this is where I'm looking at the data, and I'm trying to, I can't look at it that closely because, dude, class started and I've got other things to do. But the last two bullet points are some of the conclusions I've basically been reaching here, is that the repo rates have been steadily going up over time, and it's because the repo market's actually becoming less competitive. Think about any market that becomes less competitive, the price does rise. I mean, we remember that from micro days, that they get to set the price a little bit more. And basically, the big primary dealers are squeezing out the small primary dealers. Basically, the small banks are going to be kind of scrambling for cash. That scramble for cash, we see that scramble in the higher interest rate. Because the way that you scramble is you offer a higher interest rate that you'll pay out to get the cash, right? Okay. So let's look at what happened today. So I just wrote this slide up right before class here. So today was the 10th intervention. Federal Reserve Bank added $110 billion. What's notable here is that the banks themselves asked for 2-week loans in the amount of about $72 billion. And what was offered by the Fed was about $12 billion less than that. So what? Less, right? So if you read the sentence the way that I wrote it here, so the banks are asking for these loans. That amount represented 12 billion more, or in other words, the Fed offered 12 billion less than what the banks needed. So there's still a bit of gap, and that's where you saw sorry. That's the gap that you saw right here, right? That's the gap that you're seeing there. That the repo allocation, the green bar, represents what the Fed offered, and the gray bar represents what the banks needed. But when we say banks, we don't mean Goldman Sachs. When we say banks, we mean also the Royal Bank of Nova Scotia, as Nomura's, et cetera, et cetera.
Are any other governments contributing to?
Interesting question. So you think our repo market is screwed up? The European repo market's even more screwed up than ours, which is also concerning. And actually, the most screwed up one, which I only started getting into yesterday, and I do not have enough time to learn more about it. But I don't know, probably those shows as a kid where they said, "Want to learn more? Go to your library." The Chinese repo market. Oh my God, the Chinese repo market is screwed up. And I cannot make, if you want to see a volatile, unsteady, destabilizing repo market, the Chinese repo market is that market. And I don't know enough about the Chinese financial system to even wrap my head around how screwed up it is. The only thing I can say for that is it's fortunate that they have a communist government that aligns what the federal government does with what the Chinese Federal Reserve Bank would do. So this is the article I was reading today, last night and today. So if you're interested in this kind of thing, write down this title. This is as recent of research as you're going to see here. And it's being cited a lot now but this was done right after the credit crisis, and this has been updated. The data has been updated. But again, this goes back to that idea I talked about last week, that the first signs that you saw in the credit market, that the credit market was frozen, was in the repo market. And that's where this article basically outlines that thesis and says that a trend had started where the primary dealers were becoming more concentrated. Fast forward 9 years to today, and that article turns out to have been true, that we've just become more and more concentrated. You see this. So look at this. I think this one is really excellent picture that represents this. Look at how transformative 2008 was. So basically, as I put up here at the top here, the repo market is important, but it's actually becoming smaller because banks, the bigger players, aren't really needing it because they're already holding more reserves than need. The ones who really still need it are the small players. But look at that divergence. I mean, that is something big, or many things big, happened as a consequence of the credit crisis that are increasing in intensity to this day. If you're a Republican and you're looking at this, you are going to say that it's the fact that we overregulate the banks, that we're making them keep too much in reserves and punishing them if they fail their stress tests. If you're a Democrat and you're seeing this, you might think that big banks are just getting greedy and we need to actually make them lend out the money, maybe by like passing a law that says you have to lend out, right? Just kind of like we do now for banks are forced to lend out money to lend to housing markets where there's more minorities, just so that everyone has access to the credit markets. But yeah, look at this. So black line, deposits. Deposits are obviously, deposits being held as a percent of assets are incredibly high. Interbank loans needed as a percent of assets are pretty low. So banks are not running as lean as they used to ever since the 2008 crisis. Part of that's not surprising, but think about that. When you were born, for most of you, banks were holding 5 to 6 times more or they were needing 5 to 6 times more in overnight loans than they do today. So the demand for the loans is lower and the reserves held by the biggest banks are larger, which basically is part of the explanation. If you look at the very top here, is part of the reason why we don't see banks failing as much. Even when I was at the Federal Reserve back in the early 2000s, I don't know. Obviously it's not me closing it. When I say we closed down, it's not me. I'm not the guy shutting the bank down. But I don't know. Probably in the course of 2 years, we shut down about 4 banks in the Chicago area. That was about average, about 2 banks a year where they just ran out of assets and they couldn't pay all the depositors back. And they got their money through FDIC deposit insurance. Dude, in Hawaii, last time a bank failed, it didn't even fail. It was on the North Shore, and the bank got bought out by Territorial right at the very end that wanted to expand its operations. So banks don't even fail anymore. Let's look at this. This is it's a stolen chart, but I think it's actually pretty instructive here for what's going on. So let's start with the gray first. Gray is easy to understand. we see the number of banks growing and growing and growing up to 2008 crisis, and then we see a consolidation in the number of banks. Okay. Then, what's the total? Let's look at the red line now. Or actually, sorry, no. Let's look at the beige line. Then, what about non-bank operators? These would be not brokers and dealers, but just non-bank operators. This would be like money market funds. This would be other large institutions like a pension fund, that kind of thing. There's still a lot of them, but the decline in both the number of banks and in the number of non-bank entities is that fall off is far greater for broker dealers. So you do see, again, more consolidation around the broker dealers. But the whole scale of the operations has become smaller since 2008. Again, a market in general that is consolidating. Then, again, just going back to what we've already seen, and I don't want to go back to it, but that's our red and black lines. Same red and black lines as we saw before. That in the middle of the financial crisis, you see this fundamental shift. Now, you're not seeing the scales are different here. What's on the axes is different, so it's not looking the same to you as it did in the previous graph. But you still see that difference, that banks are basically holding more reserves and not relying on the repo market as much as they used to. Okay. So I typed this up. And again, I'll make all these slides available to you, but basically, if I interpret that previous slide, that basically, when I looked at the exact numbers themselves, that the repo market is about half the size that it used to be, from 4.3 to 2.3. So I say that because when you look at the scale of the market, then I don't want you to like go home and like get like overly concerned that the end of the world is near, because the repo market is actually smaller. So the fact that the interest rate is as volatile just reflects a smaller, more nimble market. So its importance is less than what it used to be. But as I said before, if we look at how much of those assets that the banks are holding are funded by the repo market, is like what, 15% of what it used to be. Which, when you put those two things together, it means that banks don't really rely on the repo market as much as they used to. That has fallen from the repo market and the interbank lending offering $1 out of every $10 to now $1 out of every $100. Why should you give a fuck, right? I mean, that's the question you should be asking yourself right now. Like, Shining, this is more detail than I need. Why should we care about this? Well, the reason why, in some sense, we should care about this is because all of the other interest rates are determined by this repo market rate. What you pay on your auto loan, what you pay on your home loan, what all of the interest rates are. So it means that there's actually an not existential, but there is a more fundamental question that the Federal Reserve must answer now, which is, what is the base interest rate going to be now that every other interest rate is determined off of? You can't base it off of this anymore because this market is too small and doesn't represent the true cost of borrowing money, because not a lot of players are borrowing money in this market as much as they used to. Do you understand what I'm saying? Like 20 years ago, you could base all of your other interest rates off of this repo market because this is where the big players were. And this is where everyone, the safest of safe banks, were all getting their money there. Now, this is your Royal Bank of Nova Scotia asking for cash, right? And is that really, can you really base every other interest rate then off of this? Or in other words, maybe we're being Chicken Little. Maybe we don't need to be as worried about the repo market being as screwed up as it is, because maybe it's just used to be a very important market that it functioned well. and maybe it's just not as important anymore that it function well. Okay. Okay, let's see here. Okay, let me go back to this. Okay, so the question then is, where do we go from here? What do we do with this market? And our best way to understand that is by seeing okay, while I get the other, I made 2 PowerPoints. While I'm getting the other PowerPoint, is there any news that anyone wants to talk about? Besides the fact that Sharknado, which I saw the trailer for finally today, and the movie came out years ago, looks like a really good movie. Has anyone in here seen Sharknado? Sean, you look like you've seen Sharknado. Did you see Sharknado? Oh, it looks like a really. Did you see it? I mean, I haven't. Yeah, doesn't that sound like a pretty cool, interesting? I just saw it today. Like my principal's class really wants to see it.
Easy to stand, easy to fill.
Sharknado. I have to see it again while I'm getting to this. I know, but it is.
It's not even raining.
It's flooding here. Not the flooding, the ocean. You need to go home.
I'm not going anywhere.
Storm's coming, it's coming fast.
Wouldn't that be scary as hell? Sharks coming at you?
You just wait here and wait the sharks to rain down.
Who was that? Jacob, where's Jacob? Oh man. Jacob, you gotta get this movie. Ask your guy. Jacob, you think your guy can get us that movie? It's a pretty fantastic movie. Really?
No, it's awful. It's awful.
Isn't there like
4.
multiple?
Yeah, there's like 4. I guess there's like, yeah. What kind of drugs were these writers on to think of something like this? Wow.
It's just like the idea of bombing a tornado.
Oh man. Okay, so maybe I shouldn't see it. This Dutch person didn't like it. Oh come on! Some of these are just really mean. Oh man.
Yes, throw more bombs in the tornado.
Wait, wasn't this a thing? Wasn't this a thing? Wait, so they throw a bomb into the tornado? Wasn't this something that like Trump said he wanted to like break up that hurricane by like bombing it? Yeah, you know, that's what it is, I guess. Okay, so let's show. Okay, where's the? Oh, come on! Now the fact that I screwed around, now it wants to punish me. Okay, let's go back to this. Does it make me do this every time? Okay, let's go back to this. So, again, I'll post both of these, so you shouldn't have to worry too much here about taking notes. You're just listening to me. So, what's the lead up to this? Because here's what's going to happen here at this point. We already know what the three most important economic statistics are that we need to know to be able to talk about what's happening in the economy: GDP, unemployment, and inflation. We already know what that is. So in some sense, your economic outlook has to have those elements to it. But it needs to do two things. It needs to say where we are now and where we've been going in the kind of immediate past, like a year or two. You don't need to go more than that. But, even a year, I think, is enough just to kind of see where things are going. But then the second bullet point to this, and you don't have to use regression, it's only if you really feel like doing that. But then the second one would be that you're somehow predicting what's going to happen in the future. And you can do that prediction in one of two ways. You can do it quantitatively. So for you quantitatively oriented individuals, you can do it in a way where, like in Google Sheets, where it can like forecast the data. That's fine if you want to do it that way and just have the data plot out where it's going to be based on the data points you have from the past. Totally fine. Or you can say, dude, I'm more of a qualitative person. And if you're a qualitative person, that would then mean you need to use a little bit of analysis of where the trends are going. And you would get that from the Beige book and from other kinds of outcomes I'm going to talk about here. Or I guess there's a third option. You could do a little bit of both. You could do the forecast that Google Sheets will do for you, and you could then make it a little bit higher or lower based on what those individuals are saying. So let's see. If I had to do this assignment, and again, I'm gonna post this PowerPoint, so you don't need to worry about copying down these sites. But I kind of think that until we get these Bloomberg terminals up and running, you're gonna have to use Fred, I think, for most of your economic data. Now, you don't have to. Fred just actually gets the data from the government agencies. You could go to the individual government agencies if you wanted to. You go to the Bureau of Labor Statistics to get the CPI and unemployment numbers, and you could go to the Bureau of Economic Analysis to get the GDP numbers. But why would you want to go to three different sites when you could just go to Fred, which gets us the data from there? Then, if you just want the data, this is not, and I should say this too, this is not just a 3-slide presentation then. So you're not just doing one slide on GDP, one slide on inflation, one on unemployment, and then concluding. You need to add a little bit more about things that you find of interest, things that we need to be concerned about. And that's where you have carte blanche to put whatever you want, right? If you want to focus on purchasing manager optimism, that's fine. If you want to focus on shipping container transport costs as a consequence of foreign trade, that's fine. Play around, look at some data that you think might be of interest in Fred, and focus on something. How would you find that? Where would you get some good ideas of other data to look at? Let's look at this blog. So this blog is something that comes out almost every day, that I look at every day. I think it's free for anyone to use. If it isn't, someone should let me know, and I'll find it, find some other way for you to get a hold of it. But what's nice about this from the Wall Street Journal is that it does look at data from a variety of sources, and it might give you some ideas of things to focus on. So let's give you an example here. Somebody's going to be, okay, so we'll have to see if the library will be happy with us. Or you know what I could do? I could turn these into PDFs. I could go and use my login and just create some PDFs. That way you'd get the idea of the data, right? So the big thing is going to be that you'll get an idea of the data that you want. Let me try to log in here. I'll show you this. So what's the worst movie you've ever seen? Yeah, what's the worst movie you've ever seen? Really? Oh, man. Elijah, remember that? Oh, man. How much class time did I waste? Last.
I'd like to say 10 minutes. but
Yeah,
it's not
yours.
spread
Oh,
over
my
20
God. I wasted so much class time, your valuable tuition dollars. Because I knew nothing about Twilight. And that guy had, like,
Oh, he broke it down.
yeah, man. No, I haven't seen books, movie. I haven't seen any of that shit. It's my previous generation or next generation. But what's cool about this site is, these are people that know data, and they're looking at all these other kind of various economic, or not economic, but all these other data points that might be interesting. So this one's looking at economic sentiment as measured by the Gallup poll, right? Then looking at this idea of like who's spending all the money, people with college degrees, who's been saving their money since the economic expansion. Again, and you are totally allowed to do this. You are totally allowed to steal other people's charts. So if you want to look at this, you don't have to make this chart, even if it's from Fred. If you like what they did, right? In mine, I do open Apple Command 4, right? And take a picture of the screen shot there and put that in your slide. The key thing that I'm assessing you on is the economic story that you're telling us, right? And the charts that you use to tell that story. Your physical ability to make the chart, it's kind of important, but it's not the be all end all. What are you going to need to be able to do is you're going to need to have some you're going to need to create at a minimum 3 charts. That's all I'm going to ask you to do. And you're going to have to manipulate those 3 charts. And those 3 charts are the one for GDP, CPI, and unemployment. Because if you just look in Fred, it's going to go all the way back to 1940 something, all the way to present. And if you show us that, dude, you're not giving us anything to work with. You are going to need to, as I say in the 3rd bullet point, manipulate it to shorten the time frame, maybe graph it with something else, maybe change how it's being measured, right? So showing us GDP, real GDP levels that are over 20 trillion isn't useful. You might want to show us the percentage change in the real GDP. How you do that. So this is the thing I was thinking about today as I was getting ready for this lecture. I was like, do I want to waste class time? I don't. When I say waste, the issue is that if I go up there right now and I start doing it on that computer, I'm gonna make lots of mistakes because I'm doing it in front of you for the first time right now. You're trying to take notes of how to do it. It doesn't help if I'm doing it and making little screw ups because I'm doing it right in front of you. So then I sat in my office and tried to make a video where I'm doing it. But that's going to cause exactly the same. So I made the video. It's actually on my computer. And I was like, yeah, should I post this? Because it ended up being a 25-minute video where I made like little screw ups all along the way, fixed it, and then finished it in the end. Okay. I mean, I can show it to you if you want to, but then I was like, well, why? I don't think you're going to think I'm lazy. And if you do, then, you probably don't like me anyway. But why don't we just look at videos that have been made where the person made them in a refined way, where they did what you're going to be trying to do, right? This is just like, whenever my car breaks, there's always a video where someone's fixing the car. But there's the one guy whose videos I always watch because his car seems to have the problem right before mine has it. He always screws it up. So I end up watching it like 2 or 3 times before I actually fix my car. Because if you just watch the video, you do exactly what he's doing as he's making the video, you'll make the same mistake. So I now just watch the whole video. Oh man, my window stopped rolling down. Like, and then he did it, and he broke the glass in his car. Good thing I watched the whole video to make sure I didn't do that. You're supposed to hold the glass against the door while you're taking the panel off. You didn't do that, the glass fell down. Oh my God, it split into a whole bunch of pieces, like little pieces. Oh man, that guy swore. And if I hadn't watched the video completely, then did it, same thing would have happened to me. I don't want to do that to you. I don't want to make you watch a 30-minute video of me breaking windows. These are actually pretty good ones. So I organized this in a little bit of ways here. Let me just show you each of these very briefly here to give you an idea of the motivation behind making them. Sorry, you're not gonna be able to hear it because I don't want to do the thing here, but you will be able to watch it in this video. Is he talking? Maybe he's not even talking. You'll be able to hear it on when you watch this video later. But basically, this guy's showing you how to actually manipulate the graph, to do the things on the side where you add a line, you change the axes. Again, I could do that for you right now, but it's actually better to watch this refined one where the guy actually made it and he didn't make any screw ups. And I've watched it all. He didn't make any screw ups. You'll learn the basics. Now, the idea is that what's going to happen is that many of you are not going to start making this presentation until the days leading up to the 17th. That would be when you come to my office and you say, I cannot get this graph to work. You show it to me and we work on it together, right? And we fix what needs to be fixed so that you get what you want. But I kind of want you, and I know, and I don't generally do this, but I want you to play around with it. And if you get it wrong at the presentation, that's totally fine. Dude, like this is I don't want to say, I want to give you the opportunity, and there's no disincentive to playing around with it and trying to get it to work. And you might not get it completely to work. And some of you might know that early enough that you can ask me for help, but if you don't, it's not the end of the world. I want you to play around with the data. Then, in the second video, for those of you who are wanting to do the quantitative analysis, which I would hope that you do, but you're not required to do it, who are actually doing the forecasting in that kind of way. This one shows you how to, once you're in Fred, how to actually get the data from Fred that you can then export into Excel or into Google Sheets, and then do your forecasting data with Google Sheets. This one's nice because this one just did, this person from NYU just did a video of how he actually did the one of the three statistics that I'm asking you to do, real GDP.